Well, thanks to everyone for attending today, and we really appreciate it. It looks like the rain held off this morning and the traffic wasn't too bad, and so we appreciate you taking the time. First off, let me just tell you, remind you again, this will be our last one for this year. We'll take a break for the holiday season and pick back up in the spring. This is also our 25th anniversary, so you'll see some additional stuff coming out from us here at the end of 2015 with that. We couldn't have made it for 25 years and grown and done the things that we've done in this marketplace without all of you folks, clients, friends, all of our employees. We were recently honored as one of the candidates for Business of the Year by the North Dallas Chamber. Came in the top 3, which I consider to be a pretty nice deal. And it was really an honor to get to do that. And one of the things I was telling our staff is we would absolutely never have gotten there without all the effort and time and hours that everybody has put in to making the firm successful. Today we're gonna, I was laughing telling somebody outside that we're gonna give you something else to stress you, okay? Everybody needs something else. The holiday season's coming, you don't have anything to think about, there's no presents, there's no events, there's no scheduling issues. So we thought that everybody needed their own to-do list. So one of the things you're gonna find in your packet today was we ran an actual copy of the presentation so that you could follow along. We specifically printed it so that it's white pages behind the first cover so you can write on it, take notes, that kind of stuff. We'll check with you in December, see how many of you completed, send you a grade. No, I'm just messing. But we did want to cover a lot of topics this morning, okay? So we're gonna be flying, like one of the jets coming out of Addison today when we're going through the topics. Please feel free to stick your hand up and ask questions, but we're gonna cover tax, we're gonna cover financial reporting, investments, retirement, all these different topics that we think people need to be thinking about. And a lot of this stuff is probably now till March, April, June. It's probably a good to-do list over the next 6 to 9 months of things that people should think about. So we're gonna kick it off. We also want to remind you there's a CPE evaluation form and stuff in there for you to fill out. If you would like the CPE credit, let us know. We'll make sure that all gets done. And there's also evaluation forms, in there for the speakers. And if you have suggestions for topics, we're very much open to those. We're looking at who we may bring in next year already for, say, February, March. But if you've got ideas and suggestions, let us know. There will also be handouts and videos of all of this available on the website. So if you do want to share that with someone, or if you'd like to actually cut and paste some of the video, let us know. You're more than welcome to use some of that. Our first speaker today will be Nancy Schultz. Nancy is head of our tax group and president of Chapman Hext. Nancy's been with us way too many years to talk about how long it is. We both started practicing when we were 10, and we were child prodigies, and so we were really young. But I always laugh and tell people, Nancy never uses a code section when she's talking to anyone about the tax law. So that way I can understand. She had to do it that way. But what you'll find is she speaks English in tax. And so that's what she's gonna cover today, is going through and talking about some of the different things that are going on. It is all yours.
Oh, thank you.
Yep. She has her own. You have yours right there to use. Go ahead.
So it is the middle of November. It is really hard to believe that it's the middle of November already. So it is already past time to start doing our tax planning for the year. But that's when most of us do our tax planning for the year. We are in the middle of calling all of our clients and saying, what have you done for the year and what do we need to do before year end? So let's start that with you. They put me first, so hopefully I won't put you to sleep and they can still talk later. But because tax is so interesting, right? You just look forward to talking about taxes. So the new rate started in 2012. I'm sure that you all know about the new taxes because when you do your personal taxes, and you got it the first year, you went, oh my goodness. But there's a new tax margin, and the highest rate went to 39.6. And that happens, and thank goodness they at least put it for inflation. So the 39.6 rate in 2015 is now, if you're married filing jointly, at $464,000. So I know that impacts a lot of our clients, and it probably impacts a lot of your clients. So we have to really do a lot of tax planning for people to make sure that they stay either under that or figure out how to deal with it. The other number that we have to worry about is when itemized itemized deductions start to phase out, and that's $309,900 this year in 2015. And then the last number that we have to worry about is when the new investment tax comes into play, and that is not adjusted for inflation, and that's at $250,000. So those are three numbers that are not too far apart. So if any of you or any of the people, the owners that you're worried about or you are worried about fall into those three in that middle of that, then there's a lot of planning in that area. Then corporate rates haven't changed. So they're basically they're really at 34% unless you are in a small area, between 34 and 35%. If you're in AMT, and yes, AMT still does exist, then there's pretty much a flat number. And so if you're in that AMT and we have to plan for that, then sometimes it works for us to go ahead and accelerate income because you already know what that number has to be. So if we put income into your year, then it doesn't change that number. So it's really important to figure out what our AMT number is and then work around that. So sometimes we can accelerate income and not change our tax. So that's a real planning opportunity. If we have to be falling into AMT, then to work around that. That AMT is just a nasty thing. But usually we're worried about deferring income. But again, we have that opportunity, if we're falling in between those three numbers, to be deferring income, and especially between years. It's important to decide whether we want income in 1 year or the next year. So planning is really important, and we have one of our clients here that is exactly in that position, and we've worked a lot this year on figuring if we need to defer income or how we work with their employer to move it from 1 year to the next. Property taxes, that's one way we can, which year do you pay it? Do you pay property taxes or do you double your property taxes? And sometimes you get some benefit from doing that, and we've kind of listed those out. Charitable contributions. Do you all know that you should not sell capital gains property before you donate it? If you have capital stock that's appreciated, you don't want to sell that. You want to just give it to the charity. And the reason is, if I have stock that's appreciated and I sell it, I have capital gains, right? I have to pay tax on that. Then I only have after gains tax or after gains cash to be able to give it to the charity. Well, we have a great loophole, and that is that if I give that stock to the charity, then I get to deduct the total value of it, but I don't have to pay the capital gains. So that is the one wonderful loophole that we do still have. Now keep in mind, we still have the phase out of itemized deductions, but if you're not in that, then that's a wonderful place to be. And then we also want to always, if we have capital gains that we have either in mutual funds or we've sold some capital gains, you want to look at your portfolio before year end And if you have some stock that you want to sell that has some losses, that's a good time to harvest those losses. Even if you think maybe in the first quarter you want to rebuy it. Now, you don't want to do it within 30 days, but if you want to go ahead and sell those, this is a good time to do it so you don't have the capital gains. And then you want to check your capital loss carry forwards and make sure that you've utilized those on your tax return. And believe it or not, Texas has an R&D credit. And you have a choice, so you need to work with your accountant and figure out if you want to pay and take the credit for your sales tax, or if you want to use the franchise tax credit. And it's a little complicated formula, but it is definitely worth using. And I will be back.
So we're going to change out speakers just a minute, and Chris Jeffers, who's one of our directors in the wealth management group, is going to step up and talk through some of the different insurance, retirements, and other areas.
Good morning. So many of you probably own life insurance, disability, or long-term care, and after you buy the policy, you think, well, I'll just put it in a file, and if I die, we'll look at it, or if I become disabled, we'll look at it. So there's a lot of moving parts to life insurance and these other insurance products. So for life insurance, many of you may own term insurance that has a fixed or a guaranteed level term period of 10, 15, 20 years. As you approach the end of that period, you have some options. You can either buy a new policy, let it fizzle out, or if your health has changed, you become uninsurable, or you would only qualify for a very high premium, and you want to keep the coverage. Many people don't know that you can convert all or part of that company's term policy into one of their permanent policies without evidence of insurability and keep the same rate class. So if you have one of those types of policies, look when you purchased it and confirm how many years are left on that. With disability, there's some different things to take into consideration. What the elimination period is and how long of a benefit you'd like to have that apply for. And so if your income is increased or your cash flow is much better, you've had more saving, you could always increase the elimination period, which would thus drive down the cost of the insurance. And then with long-term care, same thing. They have elimination period and benefit periods. If you own a disability policy that you've purchased on your own, many times they have a future income increase option. So if your income has risen, every so often they will allow you to increase the benefit of that. So you may get a letter, or you need to speak to your advisor who you purchased that policy through. And then review beneficiary designations. Many times if you become divorced or you get married, that's a great time to review the beneficiaries, not only on your life insurance, but your retirement accounts. There's a lot of horror stories out there where someone had their wife on their beneficiary for their life insurance and their IRA, and they get remarried and they don't change it, and there's a big windfall for that ex-spouse. I've also seen many times people who don't have children or married, and they'll put their estate as the beneficiary of a life insurance policy or a retirement account, and thus after you get married or have children, maybe that's not the correct way to do that. So checking beneficiary designations is a really important thing to do each year. And then reviewing your homeowners policies, shopping for competitive rates, so maybe consider consolidating your insurance with one carrier. If you've gotten married, one spouse may have theirs with State Farm and one with another. Consider consolidating that to save a little bit of money. And then one of the important things that we stress in a financial planning relationship is getting together at least once a year. Most people spend more time planning their family vacation than they do on their financial planning, and it's just difficult for an advisor to communicate any changes in the markets and products and services, and then trying to find out what's going on in your life via email or the phone. So a face-to-face meeting gives us a chance to identify if there's been any changes in your life or your business or any of your financials. So if you've had children, you've bought a bigger home, you've started a business, maybe you have some business partners, maybe you need to change your insurance to make sure it's growing with you, whether that's purchasing additional insurance on yourself, your family, a key employee at your business, or if you have partners in your business funding your buy-sell agreement with life insurance. Any questions about that? No? Okay. Health insurance. So many companies offer flexible spending accounts and health savings accounts, or many times you can go out on your own and open a health savings account. They both allow you to put monies into those on a pre-tax basis. The health savings accounts allows you to put in about $33.50 per person, $66.50 as a family, and those monies can continue to grow. You're not required to take those out at the end of the year. And some of them also offer investment choices. So it's a great way to add a little money to something on a pre-tax basis when you're doing your taxes. If you've already max funded your retirement plans in an IRA, there's another avenue to put some money away on a pre-tax basis. The flexible spending account, you have to flush the money out at the end of each year. So it's not as flexible as the health savings account. We're into the season of updating Medicare or registering for Medicare when you reach age 65. And then at the end of the year, if you've paid your major deductibles and your insurance and you have surgery or something you want to consider, now would be a good time to do that. I'm not recommending just going out and having surgery, but if you have something on your list there. Estate planning, Greg. Gifting, you're allowed to give $14,000 per person per year, $28,000 as a couple. Always a good time to update your wills, your trusts, directives to physicians, guardianships for minors. You have the ability to gift highly appreciated assets. Nancy mentioned stock, but you could also do other types of assets for gifting purposes. Each individual has a gift tax exemption of $5.43 million. That number has increased over the years. A lot of people think, well, wow, that's a huge number, but that does take into consideration at your death the life insurance that you own, your business, your home, and any assets. So that number, we see many people getting up to that fairly quickly, especially when you take into consideration the life insurance benefit that comes into the estate at your death. And then consider paying for family, children's medical, and education bills directly to the institution versus giving them the money for that. Make sense?
One thing that we were talking about yesterday too, just for everybody on the lifetime gift tax exemption, with all the boomers that are aging and the amount of wealth that's going to be transferred, I saw a number recently by JP Morgan or somebody that they've now upped it to $10 trillion. It's going to be moving around and flowing through the system. We really believe, and Nancy and Chris and I were talking about this, that this may be a way that the government goes back and they whack that number, and that'll be a way they can pick up a lot of additional tax dollars just by reducing that. And so if you've already used it, it's gone. They can't change it. And so it's one of the things we're encouraging people, especially with their parents and stuff, to look at is utilizing that ahead of time so that you use it before it potentially goes away. If with the big deficits we're running, and if we ever get in a position where the government needs money, that's a great way. It's easy to take tax dollars from you when you're dead.
So can I?
Yeah.
Remember, there's a lot of confusion. That number, it says gift exemption. Remember that the gift and the credit at your death are the same thing. It's not two different. I've had people think that you get that as a gift while you're alive and then you get it when you die. But it's all the same thing. So it's just, it's one. You can either use it to gift while you're alive or as your death exemption. So it's all one number.
Yeah.
So that's why Greg is saying you can use it now to gift as part of your estate plan, but then you won't have the exemption when you die.
Right.
So so using it now is a great benefit in case it changes.
Question?
You mentioned that life insurance payouts kind of against that. Now, is that if the life insurance names the estate as a beneficiary, or if the life insurance goes to a named beneficiary, isn't that outside of the estate?
So for example, if your spouse is the beneficiary of your policy,
Right.
So the state taxes are due at the second death if you're married. So that insurance monies would go to the spouse And then at that death, those are included in the estate. Yeah. So one way you can avoid that is have the life insurance in an irrevocable life insurance trust. And so if you have an existing policy and you put it into an irrevocable trust, there's a 3-year look back. So, yeah. Then here's some retirement ages when you need to consider. At age 50, you're able to play catch up in your 401k and IRA accounts. The current maximum contribution you can make to a 401k is $18,000, but after you pass 50, you can add another $6,000 to your 401k. And then to IRAs, the maximum you can contribute is $5,500, but after you pass 50, you can contribute an additional $1,000. At age 55, if you are retired, you can actually take monies out of your qualified plans without the 10% penalty. And at 59 and a half, that's when you can take the monies out without the penalty, but you always pay income taxes. And then from 62 to 70, that's when you qualify to start taking your Social Security. 65, as I mentioned, you can apply for Medicare. And at 70 and a half, you have to start taking required minimum distributions from your IRAs. There's a calculation based upon your age. You have to take a minimum amount out of your IRAs each year. A lot of people aren't aware of that. It can be delayed if you're still participating in a 401k. You don't have to take distributions from the 401k, but you do from the IRAs if you're still employed. And then 529 plan contributions, which is a tool that many people use to save for their children's education. There's that gifting number of $14,000 that you can contribute, or you can front load a child's or a grandchild's education plan by putting 5 years worth of those gifting dollars in up front.
And that number is actually 70,000, not 75.
Yep. And then review your Social Security claiming strategies if you're nearing or in retirement and haven't taken your Social Security yet. There are multiple websites, and advisors have optimizing tools to look at the different strategies that are available. And you can get your Social Security statements online. There's a Social Security website. I don't believe they're mailing those out anymore. And it'll show you what your benefits are at those different ages. And so if you take it early, you receive a smaller benefit, and the longer you wait, that benefit increases.
I have one quick question.
Yeah.
The definition of retired, if you retire from active employment and start a consulting business, with respect to delaying the required minimum distribution,
Yeah. You're still working.
even though you're working for yourself.
Yeah. Okay.
Good.
I have a question too.
Yes.
If you put 70,000 into a 529 plan, is that out of your estate?
Does it come
Yeah.
out? Yes.
Because it's in a trust, it's in a trust. So it's out of your estate.
Okay.
So anytime you have personal issues or changes, you need to talk to your advisors. And a lot of times, some of these are not that horrible, but like when you move, we need to notify the IRS. And you probably need to update it with your attorney, or there may need to be insurance company policies that need to be updated. So all of these things are fairly significant, and they will cause some changes. And sometimes you don't want to deal with them, or you don't know what repercussions they cause. But you need to, and you need to talk to your advisors. Again, we may need to change beneficiaries like Chris talked about, or we may need to do some tax planning, or we may need to change your will, or estate planning, or there's just a myriad of things that we may need to deal with. So changing jobs. It may be as simple as changing your withholding or making estimated tax payments. But there's so much that's involved in today's world as we make changes. So we want to encourage you to add that to your planning and to let us know. Okay? So I think we're going to move on to the corporate, but before we do that, I want to draw attention to that there's some supplementary information that we've added, that we've given to you, and it will give you some of the personal income tax rates. There's some retirement, all the retirement, some of the Chris went through. So it gives you all of the maximums. So I think you'll find some of that supplementary information as stuff that we went through really quickly, and it'll help you.
So I'm going to talk a few minutes about the corporate side and flipping over and just what it is you need to do over the next few months. One of the things that we encourage clients to really look at in the next 45 days or so here of the year is really what can you do to boost revenue? Are there deals you can run out and cut with people right at the end of the year? Maybe you have customers who are still needing to use, some of their budgeted dollars, or for them, it's a tax benefit, to go and spend money with your company. So it's something to look at to try and see if you can really kick it in gear, because a lot of people don't think about that, and it's a chance to get somebody's attention. And then also just managing your expenses. Back to what Nancy was talking about earlier in terms of, do we go ahead and prepay something, to take the deduction of your cash basis? What do you need to do? We do a lot of that kind of planning. We have a lot of clients at this time of the year that we encourage them to do the same thing. Go out, buy the equipment you need for the next 6-9 months. Let's front end load it. Let's take an immediate tax write-off for it. But for book purposes, we're actually going to depreciate it over the next 36 months. We'll get the bank to basically arrange for you basically an equipment term note that matches that in 36 monthly payments, makes it all work for you. But again, you've been able to buy what you needed to operate your company and get the tax benefit both. Those are things that over the next 45 days or so that really need to be looked at, just making sure you don't let benefits or opportunities pass by.
Can I add something?
Sure. And by the way, I didn't introduce Simon. Simon Martin is the managing director of our investment banking group, White Rock Advisors. So he handles that other whole side of corporate finance and structure.
So when we look at it, and we look at the number of baby boomers, we see a significant amount of small and medium-sized businesses that are going to change hands. The business owner, their net worth is tied up in the business, and in order to get that value of what they've created, they're going to have to exit. They're going to have to sell. And so when you're looking at planning, if that's something that's on the horizon, it might differ from tax planning. You might not want to defer revenue. You might not want to reduce your taxable income, because when you go out and market your business, the purchaser of your business is going to pay you a multiple of your trailing earnings. So the planning changes in terms of how do we maximize our earnings in this period so that we get the highest exit and sales price. So you just have to know what your plans are going forward with your business, how you're going to plan at the end of the year. Are you trying to reduce your taxable income, or are you trying to increase your earnings because you're looking at potentially exiting? So
exactly. And it may be that you can accomplish both, by sitting down. One of the great things that our firm does for our clients is, you hear us talking this morning, we're able to bring the whole financial reporting, the investment banking, the tax, and the investments all in a room together for you at one time. And that's really our commercial that we bring to the world, is that we can bring that. We're one of the few people in this region in the United States that can bring all those people into a room with you in just a few minutes, get on a whiteboard and talk about all the topics. So as you're trying to work your way through these different issues, you at least can make decisions that we can mathematically and tax-wise and otherwise help you understand what happens. Some other things to think about, and this kind of goes to what Simon's talking about too, is bonuses. How do you record things? What do you do? Are they going to be add backs that we get to use whenever we're looking at valuations? And that's something we do a lot with people, is what are the one-offs that you've had during the year, and how do we isolate and document those? 401k match. for people. Do you want to do that? Is that a way of both rewarding employees at the same time reducing taxable income?
And it doesn't
Go
have to
ahead.
be made before year end either.
Right.
So,
What is the timing for that? I don't remember.
and when you file your before you file your tax return.
Yeah,
So,
so it truly is a deduction that you can take, that you can get, but you don't have to actually turn loose the cash for a number of months that way. And that is the other thing I think that's in that supplemental is all the tax deadlines and stuff have shifted, okay, in terms of when things have to be filed. I say all, that's probably not true, but there's been some major shifts in there. So we stuck that in the package for you so you'd know, because that's another major change that's taken place this year.
it actually doesn't, it actually doesn't take place until the filing for years after, that start after December 31st, 2015. So
Yep.
it'll be for next filing season, but just foretelling of things to come.
Another thing to think about, and we're already having these discussions with our clients, is what do you need to do with physical inventory? What kind of count? What do you need to have for reporting purposes? Even just going out and making sure that somebody's looked at all the capex. If you have rolling assets or you have different locations, we have clients who operate in all 50 states and even some foreign countries. Just making sure that someone has gone out and taken a look at what's there and making sure that things have not walked away or inadvertently disappeared that are going to pop up during the audit process, stuff like that, that we know where the inventory is, that we can tie those things down. If you have an audit firm or someone who's reporting on your numbers, making sure that you include them in that process. So maybe perhaps, and even if you're thinking about an audit in the future, a lot of people don't realize that you really have to bookend it. So you have to have done the audit, the actual inventory observation the year prior, as well as the year in you need audited, so you can determine what cost of goods sold was and how much change and roll there was in the inventory. Someone has to test that, come out, look at your processes, procedures. So we encourage clients to look at that. We like to try and time those, and they can be done a little before year end, a little after year end. So you're not having to call your people in on December 31st, to actually do an inventory observation. Also, accounts receivable reserve, just looking at that. What do you have? What do you want to really take a write-off for? What do you want to reserve? And again, for tax purposes and for book. And then last but not least, it's just collections. What can you do to go collect some dollars from people prior to the end of the year, which allows you to help offset against that reserve? And maybe you're discounting it some, but you're getting the cash in the door and getting it off the books. Now we're moving on to just goals. One of the things we encourage people is going back and looking at 2015. What goals did you make? Did you make them? What problems did you have? What issues are out there? And then beginning to look forward already at what do we want revenue for 2016 to look like, as well as profits. What kind of marketing dollars do we want to budget? What kind of advertising expense? One of the places that we see a lot of changes taking place are how our clients deal with advertising and sales and marketing in today's digital and social media world. We just were involved in the sale of a company that is in the digital media world and stuff. Very different type process of terms of capturing data and information and buyers' habits and these types of things. It would not have even existed 5 years ago. It's all new technology. So the costs that go along with those when you're spending those dollars may be very different too in terms of what you're going to do and how you're going to spend those dollars. Technology. Well, what are you going to do there? How do you stay up on that edge in terms of what's happening? Is it cloud? Is it new software? Is it just software upgrades and updates? Planning for all of that, as well as any other innovation. We see a lot of clients today that are struggling to keep up, and our comment to them is always plan for the fact that every 36 months you're going to, for instance, change out probably most of your hardware nowadays. If you don't, you're so far behind the curve until the cost isn't an incremental issue at that point. It's a very large issue to try and get through in finance. So you have to stay up with the software that changes. You don't want to be on the bleeding edge, but you certainly want to be following that on a leading edge type thought process. And then looking at risk management. This kind of goes with, this is the corporate side of the insurance that Chris talked about. Reviewing and looking at your coverage. Do you have business interruption? You know, we got into this discussion with some of our software people recently with dealing with the cloud, with what happens if something happens in the United States and you can't access the cloud. What happens if, you know, we all just take it for granted that cell phones work, you know, that everything happens. Having been through a hurricane in the last 10 years and watched everything just absolutely shut down, you cannot imagine how lost you feel and that catastrophic cost to businesses. I mean, New Orleans was a great example of what happened, and people need to be thinking about what those potential issues could be and how you basically insure yourself around that. Earthquake insurance. You know, who would have ever thought in Dallas-Fort Worth that we would hear about that? I actually was able to get for $100 a year earthquake insurance on my home here in Dallas. It's easy to get. All you got to do is ask. Do you have new locations? You know, if, for instance, if you ended up in the Dakotas in the oil business, you know, we have clients in all types of businesses that are moving around and opening in other markets besides Dallas as they're beginning to spread. Do you have directors D&O coverage for things that would actually, in the event of some type of litigation, cover your directors and officers with anything they were held liable for either not doing or doing? You know, looking at that. Same with E&O. If there's an error, something doesn't work, and there's some kind of problem. And then new entities, just making sure you do that you're thinking about new entities we form, have they been put on the corporate policy underneath the coverage? And then new services and products. We all get so involved in some of the stuff we just forget about, you know, coming back and cleaning up some of these pieces. One of the other things that had run along when we were talking about earthquakes and stuff, we recently, in closing transactions now, when reps and warranties are done in a transaction, you can actually insure reps and warranties as part of a transactional cost now. So whenever something's done and there's actually a sale of a company, there's going to be some reps and warranties. It's another thing to think about out there in terms of coverage.
As you say, one new coverage area for many of our clients is cybersecurity.
Yeah. Right. And that's not going to get any better. I mean, it's another, I laugh and tell people, it used to be that people would kick your front door in and come in to steal from you or something or break into your business. Nowadays, they come in through the wires and they come in through all the Wi-Fi and all the systems and, you know, just the exposure. For somebody like us, and most other companies, but we have Social Security numbers. We have all types of financial data. You know, we have all these different things we have to think about in terms of what we hold and have and how we not only try and make sure that that information isn't ever exposed, but where's it redundantly backed up in several other different locations. It goes back to the technology and the innovation. And that's why we were having the discussion about the cloud versus servers, and then it's a cost versus benefit. And I would encourage you, look at those things. I mean, there are decisions to be made there. You know, I laugh, tell people, you're going to make a decision when you decide not to deal with something, okay? I was mentioning to somebody outside earlier that we were at Tate Lecture Series last night, and there was a gentleman speaking about the hidden brain. And one of the things he talked about was that we as human beings, and when we all think about it, you're going to laugh, we don't like bad news. How about that? You know, and so consequently, we will adversarially go away. And he was using statistics and studies that they had done where even if you would tell someone, if you will have a test, I can guarantee I can cure your cancer, people would say, no, I don't want the test because I don't want the potential bad news. That's hard for me to get my head wrapped around. 40% of the people chose that. And, you know, and so it's interesting how we sometimes as business leaders and management and business owners and family leaders have to basically force things to be looked at and dealt with. I know we deal with it a lot with just simple mortality issues with clients. People who don't want to deal with estate planning or what's going to happen to my company if I'm not there. And back to Simon's comment about the reason a lot of boomers are walking in our doors and asking, what do I do with my company? How do I sell this? I always laugh. It all starts, if you drill down, with pillow talk with mama. That she's like, if you die tomorrow and all of our net worth's tied up over there, what do I do? How do I live? I don't know how to run that. You know, the kids have gone this way and the company's gone that way. That's all part of that big wrapper that has to go around all these different issues with insurance, life insurance, estate planning and stuff. And it's overwhelming to people to think about that, but that's what advisors and people like us are there, is to try and drill down to that and get it down to something that's a workable process plan over a period of 6 months, a year, 2 years. Because a lot of cases we spend, 2 years, maybe getting people ready to do a transaction even, just because you've got to work through all these different issues. Cash flow, the important. This is the blood of the business and the lifeblood that goes every day. Our suggestion is that people run at least 18 months. You need to get past the 12-month period you're looking at. Really take a hard look at your cash needs. It goes back to the budgeting areas. What are you going to spend money on? The technology, all the different changes, the growth, and the goals and expansion that you have. Then just the CapEx. What is it you're going to need? And the new hires, and the new markets, new products. In today's environment, we're finding that there are a lot of, if you need new people in the Dallas market, labor market, you can't find them. You're going to have to pay recruiting fees. You're going to spend 25 to 30% of first year's comp to replace somebody or to hire new people. It's not that way all across the U.S., but it is in Dallas. And so if you're spending most of your time in this market and your main infrastructure of your company is here, it's just a more difficult market to work in. So growth and those kinds of things are expensive. You have to look at that. Lender discussions. We encourage people, be proactive about this. Go sit down and talk about, do we need to modify? We met with a client last week, and I was so proud of them that they had already sat down and gone through the process of what are we going to do next year. It takes 60, 90 days typically to get through all the paperwork and stuff to get your lines renewed, modified, through committees, those kinds of things. So it's not something, if you run into a cash problem, unless you have a lot of extra room on your line and things like that you can get fixed quickly. So you just need to look at that and be thinking ahead as part of your whole cash flow program. Look at your covenants, projecting when you're running that budget. I know that Nancy and I and Simon constantly are working with clients to figure out what are your covenants based on your projections and modeling, where do they work out? And if we do some of these things tax-wise, what does that impact the numbers, financial statements, and the bank covenants? We're very sensitive to that because it's like 3 different stepping stones that we're trying to move back and forth on, make sure the client doesn't bust the covenants while we're trying to save them tax dollars. And those are things that just need to be thought about also.
And I would say that, and this goes to your aversion to bad news and cash flow forecasting. The cost of capital goes up the closer you are to the need of that capital, if that makes sense. So if you kind of stick your head in the sand and wait until we get a phone call and say, I'm going to run out of cash in 60 days, we might be able to help you, but that is going to be so expensive. That capital is going to be so expensive. Whereas if it had been pre-planned, that capital could have been, acquired for you at a much lower cost to you.
And don't get us wrong, there's plenty of capital out there in the markets. It's not your typical just senior lender anymore, okay? There are a lot of different thoughts and processes and types of lenders that are non-bank banks, and all different types of capital sources are out there. That's part of our job, is to help you go through that bag of tinker toys and figure out how that fits together and what happens. I guess it's Legos today, huh? And I said tinker toys, but Legos that you figure out how to make that work. And then just looking at entity structure. One of the key things that Nancy and I laughed about this yesterday, we looked at each other when we were looking at this. Don't put real estate in a C Corp, okay? I cannot tell you how many clients we see that those gains get captured in there. You're going to end up double taxed. Just don't let somebody do that. For those of you in the real estate business, we've had to work numerous clients out of that. You were going to say something?
Well,
yeah.
And C Corps, people are wanting to go back to C Corps, and there are only a few instances where C Corps are your answer. With the higher personal income tax rates, that people are trying to flee back to C Corps, and That is not the answer.
And it's because the tax rates are simply initially lower over there, but the downside to some of that kind of stuff, depending on where you're going, is dramatic. Okay, so again, it's an issue to be weighed. Looking at LLCs, and again, like we said, tax rates, and then the C corp, there's no capital gains there, but there are other things that you need to think about as you're working through that process. And then last but not least here is just a mission statement. Going back and doing a fresh look, reviewing and updating your values, and then sharing it with management employees as to where are we going, what's our mission statement, what do we think the future holds, how's our business model changing. This all ends up being part of that. And I don't think it matters how big you are or how small you are, whether you do it on the back of a napkin or you do it in a formal process that gets published somewhere on Edgar. It's a process that everybody needs to look at each year. Things are changing too fast to not periodically touch the brakes and figure out where you are. I'm going to let Nancy talk in just a minute about things that we call it up in the air. These are the things that are still not determined and known yet.
So we're at the same place we were last year. In 2014, the Congress has not passed all of the most important things for businesses that we need to be effective for tax. So we have no bonus depreciation, which is new property that you get to take 50% of that in the current year. We have no Section 179. We have $25,000 you can take immediately in Section 179. Last year it was $500,000, and in the last previous years it's been $500,000. What they did in 2014 was they approved the extension of all of these items on December the 19th. I think they'll do that again. But what does that mean to you? That means that you have to make plans for your capital expenditures. You have to already know what you're going to purchase today or within the next few weeks. And so when you get that email from me, which I will send it on December 19th, as soon as I get it, I did it last year, I'll have it already ready and be ready to go make your purchase and have it all ready, and because it has to actually be in service by December 31st to be able to get that deduction. $500,000 for tax purposes, but for book purposes, you can depreciate it. Does that make sense? So it doesn't hurt your books. You can have book depreciation, which is different from tax depreciation. So all of these things, research and development has expired. Hopefully the IRS or the Congress will extend it. I think they will. The deduction for sales tax, work opportunity credit, above the line higher education credit, contributions directly from an IRA for someone who's taking mandatory withdrawals from the IRA.
Questions? Go ahead.
You mentioned bonuses, but what if a company is considering equity-based compensation when it has a stock option, restricted stock? Are there any timing considerations from a year-end perspective?
From a tax viewpoint.
It depends on it's qualified or non-qualified. Non-qualified is not necessarily deductible, qualified are deductible. So.
Well, you gotta look at the individuals too, because they could be put into an A and B position if they just exercise and not selling. It carries over as cover. You gotta look at all sides of that type of transaction.
This is Earl Clemens. He's one of our senior tax managers and very knowledgeable for any of the questions.
And I would tell you from the investment banking side that we would love to see that stuff in place by 12/31, so that if we're looking at a transaction in the next year, whether it's raising additional equity, selling part of the company, looking at all those issues with dilution and anti-dilutive and how all those different pieces put together, so that everything is nice and clear and crisp before the end of the year.
Well, that's what I was thinking. If you could do it about the same time at year end, so that from a valuation standpoint, you can have it may be easier to value.
Yes, I saw another question.
Yeah, question on anybody on this side of the fence is worried what the IRS is doing. They've obtaining tax transcript returns for personal loans like mortgages and student loans. The IRS, I think, put a stat that there was 256,000 fraudulent filings using the online access to get the transcripts, and now it's taking 2 months to get that.
That's right.
Is that true?
That is true. It is absolutely very true, yes.
And don't be shocked either if someone tries to file a fraudulent return on your behalf and to get some kind of refund or something, and you get a letter. It happened to me. Okay.
It is rampant, and there's only one piece of good news in that, and that is that all of the IRS is being tied up with the fraudulent returns. So there are very few audits out there. There is no response. There is no response to any IRS notices. So when we send a response to an IRS notice, it is months and months and months before we get a response.
Ms. Schultz spends hours sitting on the phone holding just to talk to a human at the IRS.
Yes, it is unbelievable.
You
So-
advise going straight over to the office down the street, going in there and talking to them face to face?
No. Well, I will do that, but I do not advise that you do that. Never. If I were being audited, Mr. Clements here would be representing me.
No, I'm talking about trying to get the transcript. because
Oh, to get the
deadline to
transcript?
close your house or.
Yes,
student
then
loan
yes.
deadline, I mean.
Yes.
crazy stuff.
Yes, that's what I would do.
Or
Yeah.
get really upset about it.
Yes, that's what I would do. Anybody else?
Has everybody addressed the capitalization rules that were in place this past year?
Just for my information, how many people filed amended returns or filed protective claims on the depreciation rules last year? And if you're one of my clients, you better raise your hand.
How many of you know what she's even talking about?
Really?
The IRS passed a
Okay.
new rule, or a couple of years back, they passed it, it went into place last year on capitalization of assets or repairs and maintenance. There's two big items, there's more, but a couple of the highlights is, one, if you've got audited financial statements and you make a purchase, if it's $5,000 or less, you can expense it. If you don't have audited financials, then if you purchase something $500 or less, you can expense it. The next bucket we go to is things that you might look into your repairs and maintenance. A lot of people used to say, okay, we spent $3,000 or $6,000 to repair an air conditioning unit or something like that. The IRS doesn't look to the dollar amount so much anymore as it does to the unit of property. So if you have, one example is air conditioning units. If you have a building and it's got 10 units and you replace 3, you can expense it from now on. So that could be a pretty big tax savings. So you need to look and see what your expensing is, materials, repairs, things like that, as opposed to what you're capitalizing. You don't want to set it up and depreciate it if you don't need to.
It is huge, and especially for real estate, it is huge. It was new law. It was passed. It went into effect January 2014, and so it needs to be discussed. We sent out quite a bit of information on that last year, but we would be more than happy to discuss that with you.
The one other topic we didn't touch on this morning that I can't stress enough too is the whole identity theft. We always think it's everybody else. We were discussing this the last few days. You can actually, people can go online now and actually get a $500, $1,000, $2,000 loan, actually just going online and getting it. And in some cases, don't even have to produce a photo ID to get it. So if they have someone's social, they have their driver's license number and an address, they can get a loan in your name online on the internet. And the next thing you know is you're getting phone calls from somebody trying to collect a loan. And so I can't tell you how often it should be, there's LifeLock, there's all those things. The bottom line is you need to be checking your credit reports and see who's looking at your credit reports and whether you know those people. And then depending on one of the things that I was not aware of, but we're encouraging clients now, if you are the victim of identity theft and you have that, you can actually put an initial 90-day credit freeze on your credit report. And what that means is that someone has to specifically call and talk to you and verify before anyone can be authorized to have credit against your credit report. Now you can put it up to a year, but and it costs you $10, $20. It's not. For those of us, we're not going to be out, doing things. And even if you're trying to get credit or you're trying to get a line for your business or whatever, it's simply a matter of documentation, is all it is. But it keeps people from being able to come in and access your information and get a loan without you ever knowing it's even happened. And it is happening out there, I can just tell you, rampant.
It is.
Yeah, Dallas
Yeah.
Police Department has 300 and some odd people now that do nothing but identity theft cases.
Remember, don't ever give your social security number to an IRS agent that calls you because they have your social security.
Yeah.
And that is one of the frauds that's going on.
Yeah.
We send out an email on that.
Yeah.
Anybody have
Any other questions?
Well, we're obviously sticking around for any kind of questions that you have personally.